Hey everyone, welcome back. Let me just make sure this microphone's nice and clean. There we go. You guys can hear me loud and clear? Welcome back to the Mike Rosehart Show. Sorry I'm a couple minutes late. Completely forgot that it was Wednesday. And I was like, geez, it's like 7:05, 7:06. Geez, I should probably go live for the show. So here I am, going live for the show. Hopefully it's sending out right now and you're getting notifications. So for the next couple seconds, I'll just sit and wait for people to jump on. And so when you can see it and when you're in the comments, just let me know you're here and let me know that the stream's working loud and clear. Just jumped on my phone here, so not the best operation. Again, didn't get a chance to really brush my hair or do anything. I'm just literally like, this is natural Mike, completely forgot that I had the Wise Well show. And today I want to talk about something that's timely right now, and that is the real estate market might be crashing in the next 2 to 3 quarters. And I'll tell you what I'm seeing, boots on the ground, people I'm talking to right now. Rent prices are dropping, and it makes complete sense. And for a long time, I've been quoted, and many other real estate investors I know have been quoted saying, rents don't fall. Look at 2008. Look at all the previous real estate crashes. Rents remained steady. But that was a premise that relied on the fact that there would always be people with a demand for real estate. And there isn't a demand for people to have a place to live right now. And I'm going to go into the data and specific details. So, for example, here in Ontario, here in Canada alone, there's 750,000 international students. In Ontario alone, there's nearly 200,000 international students. London, the market that I'm investing in, primarily, I invest a little bit outside of London, but primarily in London I'm investing. We have a university and a college, one of the biggest in Canada. And the college is, I think, the biggest in Canada. And they have 10 or 15,000 international students, part-time and full-time. So all of those programs have gone online. They've announced that their last semester, I believe in March, got canceled. Yeah, sorry guys, like I really should, this is just like natural, disgusting hair. Obviously, I should have brushed my hair or something before, and it's like, I have curly, crazy hair too, so I should have like given it a brush. But again, forgot I was doing the stream, so apologies for that. We're gonna hashtag COVID hair for this stream. But talking about the data around what's fueling, for the first time ever, rents are down. I have a bunch of units posted for rent right now, and I'm having to lower the prices on my ads. I'm finding tenant quality is at an all-time low. I'm finding that vacancy rates are at an all-time high. There are a lot of supply sublets in the market, so people are moving from London who are here for school or here for work, who lost their jobs done now, right? Because again, one of our number one employers are the universities and the colleges. And the universities and the colleges are, when you think about it, if they're not accepting any students on campus, and it's all online right now, which is basically what's happening, right? At Fanshawe College, they aren't accepting anyone until January 2021. So 2020 is gone. Like the students who are here for a travel semester, the students who are internationals, gone. That's tens of thousands of vacant bedrooms in London, Ontario that are not going to be filled. Then let's talk about tourism. There is none. It's done. All of the motels and the Airbnbs, they're pivoting to take on medium-term tenants. So now there's a huge supply of thousands of units that are jumping on the market that weren't on the market before. All that short-term inventory that was saved just for the tourists is now being eaten up and used to supply that demand for housing. So there was a huge demand. There wasn't enough housing to go around because people were putting on Airbnb, they were taking advantage of the tourists and the short-term stays. That's been done for the last 3 months now, right? We've had 3.5 months of terror. Myself personally, I've noticed the vacancy rates way up. I started talking to some landlords in the market. I started to talk to people who had student rentals. A lot of the students bailed. What happens if here in London, Ontario, we have, 450,000 people, something like that, and around 100,000 people in London are students. 1 in 4, and in fact, 1 in 3 of that, like almost all the students are tenants, right? So in our population, students make up a large percentage of the tenants in the market, right? So I'm going to get to that in a second. Deals, deals, deals. That's right. There are going to be huge opportunities, huge deals coming up in the next little bit because of what's happening. Now, if you bought rental properties and you're like, hey, 3 bedrooms going for $1,700 a month, and that's probably what you could have got downtown fairly easily. Now you're looking at like $1,400, $1,450, $1,500. You're gonna have to drop it potentially $200, which is over a 10% drop to get them rented right now. It's seasonally a terrible time. Most of the good tenants are staying put. No one wants to move during COVID, right? No one wants to move during a lockdown. So what we had was most of the available tenant pool was poor quality tenants who were being forced out of their houses or had to move because they didn't have the money or something to that effect, right? So it's important to think of the fact that the current supply, or I guess the current demand and supply, are both affected negatively by COVID. And going forward, potentially for the next 2-3 quarters, right? So come September, in London, there was probably, if I had to guess, around 50 to 80,000 bedrooms that were rented by students. Now, a lot of these are rented together as a group or something to that effect, but a lot of that is going to now need to be filled by long-term tenants. So professionals who are working in town, maybe some of the students are staying. My guesstimate is probably 25 to 50% of the students are gonna come back because they have some classes in person and they don't want to be at home with their parents. They just want to get away and they want to have a place to study. So I think there will still be a bunch of students coming back, but a good percentage, a large percentage, all the internationals, all the vacationers, all the international students, all the students that aren't going to come back, that's going to have a huge ripple effect in our economy here. And people are saying, oh, well, yeah, I heard a lot of people jumping on Facebook in the comments. I was debating with some people about this earlier, about how, oh, well, it's fine. I don't have student rentals in London, so I'm fine. No, you're not fine. Because guess what? When 10,000 bachelor apartments pop up for rent in September that aren't now filled, guess what? They're going to take the unprofessional. They're going to steal your tenant because they're going to discount the rent to get it rented. They're going to do what it takes to get it rented. And so the only way to get something rented in a market like this is to either drop your price or up your marketing game. Those are the two choices. Either you do a lot more showings and you do a lot more ad refreshing every single day, or you do a lot more, you have a high-end A-class unit. Chung, thanks for that. Appreciate the reminder. He was one of the people reminding me. He was like, hey, isn't it Wednesday? I'm like, oh, geez, it is. So anyway, if you have a question, guys, jump in the comments and shoot me a question. I'm just going an ad lib like I pretty much do every Wednesday. But today I'm least prepared more than usual. Okay, so talking about, thinking this through and just looking at some data, right? Like, we don't have the actual data in front of us, but I went on Facebook Marketplace and Kijiji, and I looked at units for rent, and I saw the big apartment buildings in town. Like if you look around Cherry Hill Mall, there's a bunch of apartment buildings there. They've dropped their 2-bedroom rentals to $950 and $900 in many cases with incentives even below that. And they're renting to, it seems like their standards are a little bit lower right now because it's hard to find good tenants, so they're lowering the bar and letting, a lot of people who maybe wouldn't have qualified before qualify. Because guess what? When it's a landlord's market, you can definitely be more picky with who you choose when you get 10 people applying. But when you have one person applying, you have to lower your standards because you're like, geez, I don't have the pick of the litter anymore. And so that's what we're seeing. Talking to property managers on the ground, standards are slightly dropping. Less applicants means lower standards it's basically just the way it's going to be. And so when you're competing against a 2-bedroom apartment building, apartment building with a bunch of 2 bedrooms in it that are really nice and decent for like $950, I used to be able to rent my 2 bedrooms downtown for like $1,400. I had super nice A-class quality units. And before, a tenant would come in and I'd be like, it's $1,450, that's the price. Something like that, right? And I knew that was the top of the range I could get for a 2-bedroom, but I could get it because my unit was solid, it was great. Now that same smart tenant who's a dentist or a young professional making 70 grand a year working downtown, they're like, hey, I went online and there's a 2-bedroom apartments for $950. They're not as nice as yours, but I don't need that nice. I may pay $100 more for yours because it's nicer, but before they would have called Cherry Hill and no one would have answered the phone because phones are ringing off the hook with tenants looking to rent. Now, property managers, they're answering the phone, they're trying to cultivate those tenant leads because they're so valuable right now that tenants are now in the negotiating seat. And so there's going to be a lot more deals for tenants to find better, accommodations because they have an option now. And so that means a guy like me who has the A-quality unit might have to drop it to $1,200 to crack a deal. So that's going to cost me for the next year a couple $100 a month. And potentially that could have long-term effects, right? Let's just look at cash flow. That's $2,500 right there on one unit. Now imagine I did 10 units, that's $25,000 gone in 1 year in cash flow. And that's going to have ripple effects into the, real estate economy in general. It's going to have ripple effects into what people can sell their properties for. Because again, properties are only worth what they can rent for. cap rates, right? A cap rate is the idea that you have a certain net operating income, or NOI, which is basically your rents minus your basic expenses like utilities and property taxes, etc., equals your net operating income. There's a ratio that you use to determine value based on cash flow. And if cash flow drops, values drop. That's just a hard fact. Now, mortgage interest can go down, but cap rates don't factor in interest because they assume that people are buying in cash to equal the playing field. So when you run the numbers on it, what you see is prices fall when rents fall. Or if landlords don't drop their price, their vacancy rate goes up. So you might say, okay, I'm gonna get the price, and I see people jump in the comments and say, hey Mike, I'm still getting $14.50 for that 2-bedroom. And it's like, great, that's lucky. And that is happening. We're gonna get some people that are gonna pay what we want. But by and large, it's gonna take you longer. You're either gonna get a lower quality tenant, it's gonna take you longer to get those rents, or you're gonna have to drop your price. So those are the choices. Would I rather go 2 months with no rent, or would I rather drop my rent $100 a month and have it rented, on the first of the month? If you run the numbers, it's actually better to drop your rent and not have a couple of months of vacancy. So vacancy is very expensive, right? And tenant turnover is very expensive too. So you gotta make sure you're doing good tenant selection even in these times. It's important because a tenant turnover costs you at least a month of vacancy, costs you thousands and potentially paint touch-ups and whatever else when a tenant moves out. It's the most expensive thing a landlord can go through is tenant turnover. So when a tenant leaves, there's almost always damage associated with that and costs associated with that to the tune of like $2,000 to $5,000 on an average unit with the vacancy, with the repairs and turnover and etc. So you don't want your tenants to leave. You want your tenants to stay. You want to pick good tenants that will stay long-term, that will pay great rent. That's the idea, right? And it's not a landlord's market anymore. For a long time, in the last 3 years, I remember a lot of guys I had working for me just posting units and getting them rented like that. And I was like, darn, wow, like you're so good. And it wasn't that they were good. It was just that like everything was renting so quick. People had, when you're a good tenant, let's say, you've gone through 3 different applications and not been chosen on all 3. When someone offers you a unit, you're like, oh, I'll take it. But when it's the opposite, right? When you've got like 3 landlords wanting you, all of a sudden, now you're like, oh, let's see if I can negotiate a better rent price here. I'm in the driver's seat. And so we as landlords aren't in the driver's seat right now. And it's important to be cognizant of that fact and how that's going to play out into real estate prices and how it's going to play out into our businesses. Because at the end of the day, each rental property we have is a business. We have expenses, we have labor and capital inputs and things like that. So those are all things to think about. So that's my rant. That's what I had planned for this stream. And now I'm going to leave it open to the Q&A. And you guys can drill me. You can ask me questions. We can go wherever you want to go with this. Okay. Hey Trevor, how you doing? Crash, that's super good. Thanks, Rob. Hello, Future. Hello, Parappa. Hey, Teddy. Hey, Sash McFash. Seema. Anthony. Good to see you guys all on. Thank you all for jumping on. Coolio asks, how do I take advantage of this? So I guess there's a few ways you could take advantage of this. One, this will be a great time if you're getting into a rent hack. This is a great time to do that. So if you go out and find a really nice apartment, rent it out, and then re-rent it or toss it on Airbnb. Now's the time you're gonna find a really good deal. Now's the time you can negotiate with the landlord and say, hey, are you okay if I put this on Airbnb? Maybe Airbnb isn't doing well now, but it will be in 2 or 3 months, which gives you time to stage and set up and get your business up and running and get your reviews going. So you can be at a 5-star superhost position when the time comes in a few months when things pick back up and the economy, hopefully opens back up. And I think the economy can't afford a second shutdown, so I'm hesitant to say that I'm betting on the fact that it's not going to happen, but I think it's very unlikely that a second shutdown will happen. Economically, we can't afford it. I think there'd be a strategic way in which they tackle it, but it won't be a full economic shutdown. So I don't know, we'll see what happens in the next couple of months, but that's one way you could take advantage of it. If you didn't have a lot of money, go rent out a unit cheap now. If you're a tenant, you can get a great deal on a place right now. 2, if you're going to re-rent out a unit, now's the time to negotiate with the landlord because you can get some good deals. Maybe a 3-bedroom or even a 5, especially 4, 5, and 6-bedroom houses. Student rentals are dead. So if you have a 4, 5, 6, 7, 8-bedroom house, most of them are empty or have 1 or 2 rooms rented, and most landlords don't want to do by the bedroom rentals. It's a huge pain in the ass to collect rent from many different tenants. It's quasi-legal, etc., and so forth. So a landlord would prefer to have 1 lease. Now's the time you can go in and rent an 8-bedroom right now from a landlord, probably and I see this, I've seen a landlord offering $375 a bedroom in London. That's unheard of. Market rent is like $550. And I'm seeing students posting sublets and they just want to get out of their 1-year lease. So they're leasing for $350, right? And so you can take advantage of that. You could sign a 2-year lease right now with a landlord and give them some certainty, give them some guarantee and say, hey, I'll give you $300 a bedroom for all 9 bedrooms in your house. And you rent it from them. They're set, they're guaranteed. They're getting their, I don't know, what is it, like 3 times 9, right? So they're getting their like $2,700 a month or something. And they're happy with $2,700 a month. You take those bedrooms, you rent them out per bedroom at $500, and you get the spread of $200 a bedroom. That's $1,800 a month cash in your pocket. You're taking advantage of the rental arbitrage in the market right now. This is the time to do rental arbitrage. Now is the time to do that. So that's a good option. Again, if you're looking to buy a property, I think there's some wiggle room to negotiate with student rental properties, with any property right now that's a rental property, right? So if you're buying, as an investor, you might want to discount your cash flow and say, hey, I was expecting $1,500 in rent, but maybe I should expect $1,300. Maybe it's trending down a little bit. Maybe I was factoring in a 2 or 3% vacancy, and now I should factor in an 8 or 10% vacancy, right? And just see if the numbers still work, and then use that to your advantage to negotiate a better purchase price. Now, I think long-term, 5 years from now, there's going to be a great demand for rental housing. Long-term housing for the average person is a commodity that is going to be in continued demand. That's just a fact. Like, people are going to keep immigrating to Canada. They want to immigrate to Canada, but they can't right now. That's another thing, is that there's a ton of immigration that wants to come to Canada right now, but our borders are pretty much shut, right? So there's a lot of people who want to come to Canada, who will when the borders reopen. And those thousands of people need somewhere to be housed. I think London took in 2,000 or 3,000 Syrian refugees as an example last year. And the government pays them $3,000 a month as in Canada, we give a ton of free money away when you come to our country. It's like, come here and we'll pay for you to live. It's kind of messed up, but the idea is you're investing in the person and they'll eventually earn income and hopefully pay it back in tax. And it's also just us being good Canadians. We're like, hey, let's help our neighbor out. But yeah, you give some of these Syrian families come, or these refugee families can come here with 5, 6 kids, and they're getting $6,000, $7,000, $8,000 a month tax-free cash that was being invested in the economy, and they're paying top dollar for rent. And those tenants aren't here anymore. We're waiting for them to come back when this whole COVID epidemic shutdown ends, this pandemic. So that's something to think about, I guess, as you're investing, and be cognizant of the fact that rents might be dropping. And if you're in the real estate business like I am right now, it's tough, and I feel for you. This is the time where we get put through the ringer. This is the time where where the strong survive, where the good landlords are separated from the bad ones, where the good property managers are separated from the bad property managers. The good property managers are still able to rent their units out, and maybe they have to negotiate a little bit on the price, or maybe they have to be a bit more reasonable with how often they're posting and things like that, because it's not as easy as it was before. They have to work harder, but now's the time to shine. This is your opportunity to do that. So anyway, that's my my preamble on that one. Next question. Found my spot. Scrolling. Can you go through, hey William, how you doing? Can you go through the process of lining up your trades for reno after your offer is accepted? How do you get all that set up? Yeah, of course you can. You could definitely just put in your offer right to show the property to prospective contractors or prospective tenants with 24 hours notice. And I don't even put a limit on that. Some agents are like, oh, only 3 showings. But often you put none at all, they'll take it in many cases. And so I would often rent my units out and start posting the ad for rent before I've closed on it in many cases. And I would even go to the lengths of getting contractors through and taking video and then having those guys lined up for the day of closing so that you can get moving on day one. Now, it doesn't always work out that way. Some sellers are resistant to that. But in an ideal world, yeah, you gain all that waiting time it takes to line contractors up and line tenants up. If you can have it all lined up for day one, that's a huge win. Idle money is the most expensive thing in real estate. So projects sitting, not being completed, that's really expensive. Units sitting vacant, not rented, that's really expensive. So those are things to think about. I guess bad tenants placed in the unit are also really expensive too. So make sure you do your homework during this time. Don't get desperate and just place someone just to get it rented. Because at the end of the day, having a bad tenant in the unit that doesn't pay rent for 6 months, the landlord tenant board is not in giving tenants the benefit of the doubt, right? It's just not, I guess they're giving tenants all of the, I guess they are giving tenants the benefit of the doubt, because it's really hard for a landlord to evict a tenant, and it's taking months and months, and the process is so backed up that you're months before you have a trial. So just be careful during this time. It's not favorable climate conditions for a landlord right now. And so you have to be extra diligent and be extra careful with how you run your real estate business. Okay, next one. Hey, how you doing? Good to see you too, Tommy, Ellie, Chung. Hey, Alex, what's up? Not too much here. I'm just enjoying the weather. It's a beautiful day, and I'm thankful for a lot of things today. So I'm trying to stay positive amidst the negativity. Rajesh, good to see you on. Alex says, bring on a crash. Trevor says, what vacancy and concessions do you build into your numbers typically? And are you changing that to add cushion moving forward, at least short term? Trevor, yes. It depends. I wish I could give you the answer. On McKeever's channel, I did a video about this, a couple of weeks ago. We filmed it and kind of asked me that. I said, what are the numbers you want to use? And I say, it depends on the type of property, on the area of the property. Like a C-class tenant has a lot more vacancy, damage, turnover, delinquency meaning they don't pay rent. You have to go try to collect that. That is a lot higher on that type of property than it is on an A-level property where the tenant is going to make the payments and the tenant is, and it gets in a great area where you can rent it really quick. So it just depends on the property, the finish in the property, the location of the property is a big one, the current tenant quality in the property. They all play into my decision on whether it makes sense or not for that property. So a lot of the time it's a gut check and you got to make that assumption and move on, right? It's Matt McKeever moving to the GTA. I don't know. It seems like a likely thing. I don't want to speculate and I don't want to pretend that I know something that I don't, and I might know, but I can't say. So I don't know. That's everyone saw the eviction video out of his place that he's renting now. So I think it's a likely. I think from the guys who want to, I just think in general, like him being like in LA or New York or Vancouver or Toronto, it just makes good sense. Strategically, Toronto would be a great place, I think, given like the location of his current properties and things like that, that like, it's only a couple hour drive. But yeah, I think it makes good sense to move to a Mecca. Like if you look at Graham Stephan or Kevin or all those guys who are succeeding, they typically live around LA or like New York. Most of the major media guys, they tend to go around big hubs because they can meet more people. And just in general, a lot of the most successful people in the world, if you'll notice, you look at the richest people in the world, they all live in major metropolitans. And the reason for that is there's just more opportunity in a bigger city. You can elevate and surround yourself around the top 1% in that city. And the top 1% in New York or Toronto or LA is a lot richer and more connected and more successful than the top 1% in London. And so it's one of those things where if you go into a bigger pond, you have a chance to grow bigger. And so that's, I think, the idea here in general with all of us. Myself personally, it's not just about growth for me, right? I have a family. I'm looking for something different than someone like McKeever or Graham Stephan would be looking for. I'm not looking to grow a huge channel and like dedicate my life to growing YouTube, building a business in that sense. I like to grow and I enjoy the growth, but I also enjoy the small town feel. Like my goal is to be kind of out in the country a little bit. I like that. Being surrounded by green space, having privacy are really important to me. And so those things kind of weigh into my decision more than say, and I'm not gonna say I might not live in Toronto someday or Vancouver. I might, I don't know. Right now, I just don't have a desire for that. And I think that it depends on the individual and their goals, but yeah, definitely being in a bigger pond, you will grow bigger. That's just a fact of life. And if you surround yourself with better people, you outgrow the friend group that you had, you'll if you put yourself in the next room up, that room where you're like the crappiest person in the room or like the dumbest person or the poorest person, you'll level up, right? There's the quote, it's like, show me your friends and I'll show you your future. That's it. Like if you show me your 10 closest friends or whatever, I could pretty much show you where you're gonna be in 10 years. Typically, like if you hang around them and act like them, that's usually what happens. Humans tend to act like the people they hang around. And so if you act and hang around rich people, they'll introduce you to other rich people and they'll teach you their mindset, you'll copy their mindset, and when there's opportunities, you'll follow in their footsteps and be in the same sort of ecosystem. And that leads to more growth and more prosperity. So definitely there's more opportunity living in like the GTA for sure. I was driving to the GTA, if you guys remember, like once a week. I was there for like a day and a half every single week when we bought the medical company. And that was last year. And to be honest with you, I hated the traffic. The air smelled smoggy. I feel like life expectancy would be lower in a major city, just like from an air quality perspective, a quality of life perspective. But if you're really, really rich, I can see how living like a little bit out in the burbs and a nice big like mansion type property could be great, and you still be close enough to the city that you could take advantage of the opportunity that exists there. Yeah, I could see the allure. Like if I had like $100 million, I probably would live in Toronto because I could buy a big mansion there. But I just don't have the budget to live a lavish, like to really to really make the most of a big city, you need to be really wealthy, I think. Because like traffic sucks, as an example. Like working in the city sucks, but there's some opportunity there if you're really, really rich. You can't even buy rental properties for like less than $1 million in the downtown, like proper downtown core, right? So you need a lot of capital to really do anything down there. And so I don't know, real estate's only one piece of the puzzle, right? There's so many pieces to building wealth, right? And I think that what you'll notice is most millionaires make, like, I think it's like 90% of millionaires, I read a stat, it's like low 90% of millionaires made their money through real estate. So the majority, the lion's share of millionaires made their money through real estate. The lion's share of 100 millionaires and billionaires, they didn't make their money through real estate. They made it through businesses. So you make your first couple million typically in real estate. It's the most common way people build wealth, in their house and a couple rental properties, things like that. It's an easy way to build some wealth. But then the majority of the wealth that takes you from like 5 million to like 500 million, or from 5 million to 50 million, typically that's in owning businesses. That's the best way to do it, is to invest in businesses. So that's what I want to eventually be doing, is buying businesses. And there are no good businesses for sale in London. There's lots of them in Toronto that you can buy and turn around, like everything from manufacturing to production. There's a whole bunch of different types of businesses that exist in large metropolitans. There's just 10x of everything. There's just 10 times the opportunity. And so, yeah, I could see the allure of, if your goal was just to build a brand or just to build wealth, that being in a big city would totally align with that, more so than living in somewhere like London with 500,000 people. And London's all right. I personally feel better being a big fish in a small pond. I like that better. That's just more my style than being like, you know, a bigger fish, but in a giant pond where I'm like still just like a minnow. And that's just me. Like, it's probably an ego thing. It's probably just like I'm watching the Jordan documentary right now, The Last Dance. Fantastic documentary. I'm not even a big basketball guy, but like loving it. Love the work ethic, love, you know, a lot of the message behind, you know, being like Mike and, right, the whole campaign and stuff, right? But just like watching that movie and thinking through, you know, a lot of the opportunity, it feels like, oh shoot, I lost my train of thought there. Where was I going with that? I don't know. Just being like the people you're around, right? If you surround yourself with greatness, I think the point I was trying to make was that if you surround yourself with greatness and you surround yourself with, you know, top producers and achievers, you will elevate. But at the end of the day, like, it's up to the person to decide, you know, where they want to be with their life and what are the most important things. Sometimes the most important thing isn't money. Sometimes the most important thing isn't, you know, success or fame. Sometimes that's the worst thing, right? So it just depends on your goals and what you're looking for out of life. So, great question. Rents are falling, yes. On average, so rents have been going up forever, and they continually will go up. But let's be clear, the average one bedroom is rented for like $800 right now, but you can rent a one bedroom right now for way more than $800. That's because the average includes a whole bunch of units that were rented like 5 years ago, and like by a bunch of, you know, the dumb landlords too, right, who just rent their unit for whatever. You got mom and pops who haven't looked at the market. I see people post ads sometimes in the paper, and they don't even know what the internet is. They don't know what market rent is at all. So that includes all those averages too. What I'm saying is that there's a lot less tenant demand and a lot more rental unit supply on the market right now. And I talked about that in the first 10 minutes of the video, 15 minutes of the video. Go back and watch that if you're just jumping in now, and you'll get the whole overview of that and what that was all about. So just check the replay if you want to catch all of the details on that, about how immigration is affecting things, how we basically have less tenants in general looking. Yeah. Next question. Okay, I'm gonna scroll up and find out where we're at. We were talking about the process. We did that question already. What vacancy and concessions do you build in your numbers? We did that one. I told you it's kind of depending on the property and so many factors. Got to catch the replay. Need to make a run to Home Depot. How to save? That's awesome. Glad you're getting stuff done. Sounds like going to Home Depot is getting value and crushing things on the real estate side. So congratulations on that. Can you explain the value of a refinance in layman's language? Having a hard time understanding the value of the third R in BRRRR. What am I losing out on if I'm refinancing now versus post 3 years versus 5 years? So opportunity cost is effectively the term that I'm trying to articulate here. And opportunity cost basically states, and I'm just, you know, ad-libbing this, so don't hold me to the fire, but it's the idea that your money could be doing something else, and every decision you make has a cost. And so as an example, if you give $10 to your mom or your friend and you charge them nothing, you could have taken that $10 and invested it and grown it at 10% and you'd have $11. So the opportunity cost of your $10 of your decision to give that money to your mom is $1. So there's $1 opportunity cost. In the same way with the rental property. If you have a property you bought for $100,000 that's now worth $200,000 and the mortgage was the same, you haven't refinanced, you've got an extra $100,000 in equity sitting in your property. If you've paid down your mortgage, it's probably more than $100,000. A lot of people have huge amounts of equity trapped in their rental property or in their primary residence, their home. They're trying to pay down their mortgage, which again is terrible advice. It's recommending someone gets a guaranteed 2 or 3% return. When you pay down your mortgage, you get a guaranteed return of the interest rate on your mortgage, which is a terrible return. I think anyone getting less than a 3% return needs to go talk to an advisor or find a better investment vehicle. It's just terrible. It's not maximizing your returns at all. So the idea is you want to pull that equity out of your property as soon as you possibly can. Because let's look at this example. Let's say you could just do like private lending at 15% or something, or let's go 10% for easy math. 10% is a conservative return. Let's use that. So, and it's easy math for me. So, okay. So you've got a property with $100,000 in equity in it. That $100,000 could be invested in generating you $1,000 a month, right? So if that could make you $1,000 a month right now, you have to say to yourself, do I prefer to have a property where I'm saving, what's 100,000 times 2.5%? So I guess like $2,500 in interest. So by not taking that money out, yes, your mortgage payment is lower. So you're saving yourself $200 a month in interest payments by not pulling the money out. But I would argue, pull the money out, invest it elsewhere, make $1,000, and of course you'll have your $200,000 cost of pulling that money out every month, but you'll have a net spread of $800 positive. And if you could take that money instead of lending it out and buy more properties, you get a way higher return than 10%, often 30, 40%. And so your money could be making you a huge spread. Instead, it's trapped in your property, saving you like the rate of your mortgage, which is often 2 or 3%, which is a terrible rate of return. If you pull that money out of your property still appreciates at the exact same rate. It still generates the same rental income. So why would you trap extra money in it if it gets you no extra return? That's the idea. You don't want to own properties in cash. Owning properties in cash is a terrible proposition for the long term. For short term, it can make sense, but long term, you want to refinance and pull the money out. Levered real estate investing is the only real estate investing that makes any sense in the long term. So that's why we BRRRR. That's why we pull and refinance the money out of our properties, because it's just trapped and it's not doing a good thing for us. And you want your soldiers, your money minions to be working for you at all times. And we're not all perfect human beings, but we definitely want to try our best to take advantage. The next question is, I just got promoted at my job and I'm basically living frugally off the cash flow of my house hack. My total pay with bonus is going to be a projected $85,000 a year. That's amazing. That's awesome. So I guess, what is the question here? I don't see a question here at all. That's amazing. Maybe there's a follow-up question. I'll have to scroll down and find. Oh, here it is. My goal was to buy 2 rentals this year, and it looks like this might happen faster than expected. I'm pumped. Okay, so you're just letting everyone know. Yeah, I think that's totally reasonable. With that kind of salary, you should be able to qualify for rental properties. And if you're living in a house hack, save most of that income to invest in real estate or whatever you want to invest in, right? So definitely an opportunity to build your net worth. That's awesome. Can you explain the value of refinancing? We did that question. Now we're down here at smash the like button. Rajesh says, freehold townhouse versus a bungalow built in the 1970s versus a duplex in the 1920s. How do I go about making wise trade-offs of budget versus appreciation's value vs rental cash flow vs repair expenses? So I guess at a high level, it depends on when the properties were last renovated, because it's hard for me to tell just because when it was built, the current condition, right? You could have a 1920s house that's been entirely rebuilt gutted from the ground up, where it has nothing old in it. In which case it could be, for all intents and purposes, have lower maintenance and lower repairs and capex than a house that's 20 years old, because it's had, basically everything's new, but it's an old built house. So it's hard to tell. But assuming at face value that the one is like freshly renovated and new, the other one is like from 1920 and hasn't been updated, expect to have to bring it up to today's standards. And so budget in electrical, plumbing changes, et cetera, and so forth. If it's an old building with old infrastructure, as in like the plumbing hasn't been updated and the wiring hasn't been updated and the roof's like 20 years old or more, factor in those extra costs in your cash flow. From an appreciation standpoint, it depends so widely on location, on so many more factors than what I have here, and it's hard to make absolutes off of that. But you'd have to make some trade-offs and say, hey, like maybe the duplex can bring in $400 more a month cash flow. Well, will that be enough to cover the freehold condo differences in maintenance, right? Because one will have more maintenance than the other one will. By and large, attached townhouse type properties have lower expenses because they share common walls. So your utilities should be a little bit less. That's something you can factor in. So utilities have a little bit of a factor. Maintenance would have a bit of a factor. Your tenant profile might have a little bit of a change depending on the two different types of properties. There's a few things you have to think about when you're trying to make those comparative trades. It's tough. It's situational. Very much so. Depends on the property, and it's tough to make that call without more data. But yeah, you want to make that comparison and do your best to say, which one, at the end of the day, which one net cash flows more. That's the most important piece. From an appreciation standpoint, I tend to find detached structures appreciate better than attached structures, usually. But there are exceptions to the rule. Location is a bigger factor than type of house, right? Like two different condos or townhouses, two different areas of London or wherever the city will appreciate at different rates, right? And there's crazy factors, like sometimes a random townhouse condo in a complex will sell for a crazy amount of money, and then the comp is set, and all the comps start trading really high in that condo complex where it just takes one or two sales to trigger it. It's weird. I know someone who bought a bunch of condos in a place, and they actually control the market price. They'll sell one every so often for a really high price to a friend to keep their comps up. You can actually control the market in real estate. It's pretty messed up. It's like insider trading or whatever, but it's legal for some reason. And like you can literally own a whole street if you wanted to and control the price of housing, and no one can stop you. That's legal here. So real estate, you can arbitrage. And so eventually you could, in theory, try to make some bets on who's investing in different areas. Again, I don't like to bet on appreciation. I like to just use a standard benchmark of like 2 or 3% and just say like, appreciation is a bonus. I'm not playing for appreciation. If it happens, awesome. If it doesn't, I wasn't playing for it anyway. I was playing for the cash flow. I was playing for the equity build, from renovations or whatever, the lift I get on day one because it was a wedge deal or an arbitrage deal. Hope that answers your question. Now to find my place again. Scrolly. Found it. We have a house paid off in the UK. I wanted to refinance to get a flat. My husband just wouldn't refinance. We don't have any British pounds. It's so frustrating. How do I convince him to refinance? Show him the math. Say, look, I want to pull the money out of the property. It's going to cost us $300 more a month in interest payments and maybe $200 a month in principal repayment. But principal repayment doesn't matter because it's just like you forced saving for your future self. So just count the interest portion and say, look, the interest portion is going to be this amount extra. And I want to go buy another rental property or do this with it. And the cash flow from that opportunity is an extra $1,000 a month. And so, or whatever you're going to invest in, just do the math and say, look, I'm very sure that I can get greater than, the cost of the interest on this debt we're pulling out. And if you are sure, like you should be, because 2 or 3% is a terrible return, you should be able to do better than that almost always, almost certainly guaranteed. And almost any investment, you can do better than 2 or 3%. But I guess if you don't want to take any risk, then you couldn't. If you're just going to buy like treasury bills or something. But yeah, that's the argument. So people who are super, super risk averse, who would probably never buy real estate, who probably never buy stocks, who probably never buy anything of any risk at all, wouldn't even do private lending or anything like that, those individuals might just pay off their mortgage because they wouldn't take the money and invest in anything anyway. So there's no point in pulling the money out of your property if you're just going to hold on to it in cash or you're just going to do nothing with it, right? That doesn't make sense. Unless you need the cash for liquidity purposes or to take down deals or maybe for some financing reason, I could see a narrative where that would make sense. But by and large, that's the narrative or the math behind that or the logic behind that. Hopefully that helps. The next question. Vacancy hurts not only the expense, but your wasted time. Yes, very true. Time is a ROT, or return on time, is something a lot of people don't factor into their investment vehicles, and I think that's a mistake. Gail says, hi Mike, how are you and the family doing? Gail, I'm doing well. Thank you for asking. We're all doing well. We're obviously not having any issues with COVID because in London, I think there's like 1 case right now. So my city's pretty safe. That doesn't mean I don't take precaution. That doesn't mean I don't wash my hands. I'm not shaking hands to anyone right now. I'm keeping social distancing. I'm honoring all of that stuff just for like the off chance that I could get it. But looking at the data, people under 30, I think there's been no deaths, none. No healthy individual under 30 without pre-existing conditions has died, I think, in Canada. Average age well into the 60s. So you have to have a pre-existing condition or have a old age, which is again, basically a condition, right? So those are the two things that make it risk. So if you're a high risk individual, protect yourself, quarantine, get your groceries delivered to you, sanitize everything, and don't go out with the world. But if you're someone like young who can, afford to take the risk, I would say the probability of getting it pretty low, and then the probability of actually dying from it if you're healthy, it's almost zero. In fact, the data says 0.006%, the same as the flu for someone who's healthy, who has no pre-existing conditions and is of a young age. So that's the data we now are operating on. We know it's not airborne. We know it doesn't last long on surfaces, a lot less long than we thought. It doesn't really transfer from asymptomatic individuals anymore. So all that stuff, I just want to share all that because that's what we know now, is that a lot of the decisions that were made. I think we could have done a different type of lockdown where we were very selective and protected people and put in procedures that protected people, right? Like the social distancing rules that we have now are great. Businesses are operating differently than they did before. And so a lot of those rules needed to happen to make us safer in general. It really does stop the spread of the flu. I think it's going to save thousands of lives. Even when, forget COVID, it's going to save thousands of lives from the flu alone, these new policies. And so I'm very pro a lot of these changes that businesses are making to be, to support, I guess, the stop of spread of viruses and people being more cleanly and just in general. So yeah, wash your hands, social distance. Businesses should be wiping things down between people coming in. That's just, there should be distancing in lines and things. These are all great things that we're doing now that we should have been doing before. Yeah. Next question. Okay, we're there. Question is about financing. If you get up to 12 doors and 3 or 4 loans and quit your job, is it possible to still get financing off of cash flow or net worth? How do the banks treat this? It's a good question, William. The banks don't like to lend people without T4 income, by and large. That doesn't mean there aren't alternative lenders or commercial lenders who will lend you money, but it is going to be harder. It's a harder sell to the bank. If, however, you have a strong net worth and you have cash flow for the properties that you have, commercial lenders at the big banks, the A lenders, will still lend to you. It is more difficult. You will have to make a good, compelling case that your properties are cash flow positive. You're going to have to make a good, compelling case that, you have to do. It's going to be harder. You have to make a good case to the lender. But yes, you can still borrow. It's going to cost you more. Your debt's going to cost a little more, but that is what it is. Lending in a corp is also very difficult to get done too, right? So borrowing in a corp, I guess, is so to speak. The lending process is more complicated, right? And that's just the nature of the beast in the business. And so the longer you stay at your job, the better your financing prospects will be. But that doesn't mean you can't still do deals and still get financing after you retire or quit your job. So something to think about. Get some more deals before you quit your job if you want that premium financing, the cheapest cost of debt possible. Okay, next question. Happy to help, William. Thank you. Harpreet says, which city you prefer to start real estate investing for a new investor? Harpreet, it just depends on where you're living and a whole bunch of other things that come into play. I personally like London. I still like the long-term fundamentals for London. Short-term right now might be a good buying opportunity as opposed to a selling opportunity. We do actually, right now we have a dead cat balance and that the market's really hot, but I think middle term, we're going to see a little bit of a dip, and then longer term, I think we'll be strong again. So find places you can invest for cash flow, but I think investing in your backyard makes the most sense. The place where you live and where you want to be long term, because you're close to your property. You know the neighborhoods, you know the area, you can touch and feel that. And so that adds a level of comfort and safety in your investment, because in real estate, it's about how much you make a big factor in how well your property performs. It's about the individual's, concentration on watching the managers and just all that stuff, all that active management or thought that goes into it. It's not as passive as buying a stock. I can think about a stock all I want. I won't change the price. You think about a property, and that'll actually have an impact on the property, right? So you're in control more so in real estate, whereas in the stock world, you aren't in control. It doesn't matter what you think most times, unless you're a huge player. Okay. But yeah, I guess in southwestern Ontario, I guess would be a good place to look for. If you're living there now, you could look at, you know, cities like London, or, you know, I guess Windsor's okay, Sarnia. I kind of grew up there. It's okay. The market fundamentals aren't as strong, but cash flow is decent. I haven't heard any landlord in trouble yet. I wonder how the new investors are doing, especially ones who bought within the last year. For the most part, people bought smart, and it's going to be a long time before you hear about it. You probably won't hear about it, to be honest. No one talks about their failures, right? I've had a flip go bad recently in the last year, and it's the worst deal of like 50 deals I've ever done. And you don't hear me talking about it. I will talk about it. I'll do a video about it once it's sold, and I'll tell you about how I've lost money. My first deal ever where I lost money. It's because I didn't rent it out. It's because I did a flip, and I made some mistakes along the way, and I learned some things. And I probably lost $10,000, $20,000 on that deal, maybe more. And so on average, I've won, but there are deals where you lose, and those deals are going to be more common. You're going to hear more about that if people are willing to be honest and transparent. Most people won't be. Most people will just share their success. Rah, rah, I'm succeeding. I'm trying to find JV partners, and that's what you hear, right? People are just talking about their successes all the time, but failure happens too, and I think there's going to be more failure now than what we saw before. People aren't going to talk about the fact that they had 6 months of vacancy, or the renovation took twice as long as the COVID. They're not going to share those things in the same way that they're sharing their successes. So that's just the nature of it, but it is happening, and people are taking longer to get their renovations done. It's costing them more. Those types of things happen, and people aren't making as much money, and that's just the nature of what we're going through right now with COVID. George says, what do you think about becoming an agent to offset commission fees? I want to invest primarily. So George, I became an agent for the same types of reasons, but by and large, I don't use, for the most part, I don't even use my license other than for my own personal stuff. And so is it worth it? It costs you a few $1,000s a year to keep the license alive, probably like $6,000, $7,000 a year to be at a brokerage and pay for your insurance, et cetera, and so forth. So the question is, are you doing multiple deals every year forever? And if you plan to do multiple deals every year forever, then you'll break even. If you're going to do like 10 deals every year forever, then it would make sense. So it depends on whether you want to do lots of deals or not. If you're going to do 1 or 2 deals, just cut a deal with a local agent where they kick you back some cash or something. That's a better play. Or have them, you know, give you access to stuff then, rather than, you know, buying the license. You're doing a lot of volume for it to make sense. So yeah, I guess, what is that volume amount? It depends on the types of deals, the size of the deals, but I would say like around 10 properties a year tends to be worthwhile. Jason says, hey, how you doing? Good evening, D how to? Elliot, yes, rents are falling on average for new listings. Hey Mike, what's your plans for the laundromat you purchased? To be honest, sell it off. I have no interest in running a laundromat. It was always the plan to sell it off. I used to work in San Jose, California, Silicon Valley. It took me over 2 hours to drive 26 miles to work. It took me over, you repeated the same thing again. So you're correct about major cities. Yeah, exactly. There's pros and cons, right? And you have to weigh those and decide, you know, what makes the most sense. Yeah, with telecommuting, you don't really need to live in the big cities to connect with people, but I think there is an advantage to being able to get in person with them, to be, you know, in that local market. So there are some advantages, but less and less that divide exists between small towns and big towns. You could live almost anywhere in the world now and potentially be connected through, you know, virtual workshops and things of that nature. Alan says, do you believe that you discount the value of your MBA from a day-to-day decision-making perspective? I recognize the manner of thought in the speech it has made on you. Alan, to be honest with you, like you're talking about the Richard Ivey School of Business and just, you know, professional business degree in general. Even a degree, like at a university in general, I would say most of the way that I think about things today is through the lens of experience. So if I had had 4 more years of experience in the field, as opposed to 4 years in school, I think, to be honest, I think I'd be further ahead than I am today. Like wealth-wise, and from a leveraging or referencing experience, right? People who get into the top, you know, university programs, the top MBAs, etc., they're already really smart and successful people. The school didn't make them successful. It just so happens they recruited a whole bunch of really successful and smart people. And then they get to say, hey, our graduates earn twice as much. And it's like, without the program, your people would have earned twice as much probably because they were already the top of the top, right? So my logic has been all the theory stuff that I learned I could have learned by taking like 6 or 7 online courses, one on tax, one on economics. I could have done pretty much all of it online and had a similar theory understanding. In fact, probably with the field experience I would have had, I might have been further ahead. So I don't know. There's value to it, yes. You can say you've been through a pressure cooker and succeeded, top 20% of your class or whatever, and that sounds great. And like, I guess it did shape, it did shape me in some ways. I'm not going to deny that. But did it have impacts on me in the same way that the field would have? No. A lot of what I learned, or some of what I learned, was not valuable in the real world, right? But yeah, there were some classes that were really, really impactful. And some of those classes, like entrepreneurial finance that I took, and the tax courses that I took, and the economics courses that I took, those were like extremely valuable. I used those to make 6 figures in in the business that I bought. I used a lot of those same skills. And so yeah, it's been worth it for me. I don't have any regrets. I'm not going to say I regret my life decisions, but yeah, it's a tough one. It's a tough one. Is it worth the 2 years or the 4 years or whatever of lost time to do that, and the tuition costs, et cetera, and so forth? It's mostly the lost time that you spend investing in that education program. It's a tough one. Because I know a lot of people that I graduated with, not a lot, but I know people that I graduated with, or people that I've met that have graduated in different years than me, even that I just met in the field, who are dumb, like not smart at all, went through the exact same courses and just idiots. So if the program actually made you, think like someone's, who's super wise or whatever, wouldn't those people be, thinking wisely? And they don't. I think maybe experience might have been better for them in some cases. So I don't know. I'm of mixed opinions on it. I think that spending time improving yourself, so self-improvement, is important, very important. And so instead of doing an MBA, you could do a bunch of online great courses or do some coaching programs that would take you to the next level, and they would take you a lot further than an MBA program might. I think it's too shoot and spray. It's not, focused enough on your specific goals. Whereas if you could pick and choose all the stuff that's just pertinent to what you need for your business acumen or whatever this field you want to go into, if you could pick and just do the stuff that you care about. I took sustainability courses that I'm never going to use any of the crap from the sustainability course, or the CTO courses, the tech courses that I took and stuff. And I just won't use a lot of that stuff. There's a lot of things in the program that was valuable, or some of the marketing stuff that I took, never going to use that stuff. So I don't know, there's some stuff that you just won't use, and so you waste some time on that you could have spent doing something else. There's a lot of networking that goes on too that is somewhat valuable but can also not be valuable, depending on the field that you go into and how you want to live your life and stuff. So the answer is, Alan, it depends. Depends on a lot of factors. Next question. I'm gonna wrap this up pretty soon if I get through all these questions, because I'm getting fatigued. It's time for the lightning round. Where is my question? Can't find you guys. Okay, I found it here. There we go. D how to, great comment. Al says, where are those tenants going? Back to their parents' house? Yeah, I mean, theoretically they're going back to their parents' house. A lot of the immigrants that were going to be here are just living in their home country because they can't come here. So tens of thousands of those people are just not here that would have been. All the travelers who would have been here, they probably would have just kept paying for their house back home, and now they're not coming here, so there's no need for them to rent anything. And then the international students, again, back at home, same thing. People who would have moved here for work that aren't now are probably just staying in their old apartment. So that kind of stuff. Where there's less, and also let's remember that when people are making less money, they can pay less for rent. When money was, there's money just being handed out left, right, and center, the economy was booming, everyone had good jobs. Now people don't have jobs, and so there's going to be less, I guess, tenants won't have as much disposable income to throw towards that luxury unit that they wanted. Now they have to go with the B unit. And so then who's going to take that luxury unit, et cetera, and so forth. So something to think about. Mike, question about private banks that allow you to hold stock and borrow most of the money back. Couldn't you do something similar, just holding the S&P or TSX futures contract and 20% cash? Yeah, in theory, you could do something very similar like that. Yeah, you could lever up without going through private banking, for sure. Hi, Mike. I want to help people invest their money. I want to start investing in London. How can I work with you, and how can you mentor me? I live in Toronto. I need some guidance. Ruben, I'm not doing any mentorship right now. Occasionally, I'll do some coaching calls and stuff like that on on occasion. It's not been my primary focus to like a coaching program or stuff like that. So it's not my primary business, but I'm here to help you and however I can through the live streams. So if you want to invest people's money, the first thing you have to do is prove that you can do it with your own money. So start by investing your own money time and time again, prove that you are successful at that, maybe then borrow a little bit of someone's money, like your family or friends' money, and then successfully invest their money and do well by them, and then go to another person, prove you're successful with their money, go to the next person. Because as soon as you lose someone money, your brand's dead, right? So you gotta keep that in mind too. Try not to lose. The most important thing is to not lose people's money. And part of building a brand is just, I've always thought the best way to build a brand has been to be successful yourself. So just achieve. Go ahead and start buying properties or investing in things, and that's the way to do it. So if you want to learn about investing, yourself and that, I'm happy to be a resource to help you through that. Not to be too dark or harp on the government, but do you factor in inflation risk into your offers? How do you handle or calculate rent increases? So Trevor, yeah, I mean, inflation is a risk, and that's why if you lock up a property for 6 months, like right now you could do that. Some properties you could go in and say, I'll close next year. And landlords are taking it because there's no other offers on the table in some situations. And so, yeah, I mean, you could take advantage of that and then have a year of appreciation by the time you close. I did that once. I did a deal that closed like 11 months from when I offered on it. And it was, by the time I got to closing, it had appreciated so much that I had my down payment in equity when I closed on it. So that's a cool opportunity when you can do that in an inflationary environment. For tenants, there's nothing you can do. The CPI is at you can increase your rent by like 2%. I think it is 2.1%. And that just is what it is. So yeah, there's nothing much more you can do in that respect. If inflation goes crazy, hopefully the government will, I guess, adjust the guidelines and not play with the numbers. They'll probably just play with the numbers and adjust the basket of goods. But let's just assume they didn't do that. Then you get, if inflation was 10%, you get to increase your rents next year by 10%. It would always be a year lagged, but you at least have that. So there is some form of protection for landlords. What if you have parents who paid off their house and no longer have a mortgage? Do you think it would be best if they were to purchase another property and rent it out to have additional income? Gail, yes, that would be probably a good use of their capital. I can almost guarantee that if they bought the right type of property, they could have cash flow a lot higher than the interest payments on the mortgage for the money they took out. Hopefully you take the money out from the property and then get another mortgage on the property that you're buying, so you're just taking out the down payment that you need. You don't ever own real estate in cash. If real estate makes sense only with debt, it means that it is too risky for most people. Brent, I guess so, but I would argue that, yeah, I would say most people are risk averse, and that's why they're poor. If you're risk averse, you will be poor. All the wealthy people in the world take risk, calculated risk. Now, if you're in control of the rental property, you can control whether it rents out or not. Even in a hard market like this, if you're posting your ads daily, you'll rent your place out. So if you're in control and your rents are triple what your mortgage payments are, it's not like the risk that I won't be able to pay my mortgages on my properties is like near zero. I have more confidence in my ability to make my mortgage payments with my tenant's rent than I do buying bank stock, or that I do honestly buying government bonds. I think the government has a higher chance of failing than me not being able to rent out at least half of my units, because my break even is typically around half. So yeah, I mean, it's possible we have no appreciation and that tenants don't pay, but very, very unlikely. I think long-term what we're going to see is that prices keep growing on real estate over 10, 20 years, right? They're going to keep growing at 2 or 3% a year. And so that should offset the debt right there, and then the cash flow is a bonus, or other way around, cash flow covers all the debt, you have some positive cash flow, hopefully, and then you also have the appreciation. So I guess most people are so risk averse that they don't even invest in equities. And if you're that risk averse, then you can probably never retire, because you literally need to save you need to save so much money, because you'd be basically investing at like 1% return or 2% return, right? Putting your money in a bank account in Mexico or in Costa Rica is way riskier than buying real estate in a developed nation like Canada. So I guess it's all relative. How do you value that risk? So I think that comment's kind of unfair in some ways. Bruce says, hey Mike, if a secondary suite is added to a property with long-term tenants occupying the main unit and I Airbnb the second unit, would banks and insurance companies automatically deem it a commercial property? Insurance companies would deem it commercial. Most banks would consider anything Airbnb, short-term rental, to be commercial in nature. The government considers it in Canada. You have more than $30,000 in income from the property, so that's like $2,500 a month or more. You have to charge HST on that Airbnb income. So that's my understanding, is that yes, it becomes commercial. And once it becomes commercial and you charge HST, on sale, you have to charge HST on the property. And residential properties are exempt from HST. Like, you buy property for 400 grand, there's not like $45,000 in HST. There is if you have, if it's an Airbnb property, technically. A lot of people aren't enforcing that, but that's the way it should be. That's the legal letter of the law, I guess. What do you say about leverage returns? Does it make sense purely from a perspective of dollars and cents, when you already have a huge net worth and can afford all the risks otherwise? I would say leverage returns are a great way to go. Keep some liquidity on the side so you can cover your losses. But yeah, leverage returns are like 4 or 5 to 1. So if you're investing in things that are solid, like, you know, the S&P 500 or you know, real estate, then yeah, levering up makes sense, because you're going to get a guaranteed positive return of like 3 to 5%, almost, like, historically speaking, yes, guaranteed. If you're diversified, you will get 3 to 5% guaranteed. So if you could, probably 7% actually historically. So if you can get that spread, then you can borrow at 2.5%, 3%, get the 4% spread levered 5 to 1. That's great. It's in your, that's a almost no risk levered investment. What is your game plan to take advantage of opportunities in the market? The same as it's always been. Look for undervalued opportunities, you know, evaluate them conservatively, and then buy them if they make sense. Where do you see Western going back in the fall? Online learning is not ideal. Jason, I agree. The fact is, it is mostly going to be online, unfortunately. That's what we're seeing. The international programs are postponed until 2021. So there's a whole bunch of the international community that won't be in class in person. So yeah, it's going to have a big impact, a big change, and it's scary. It'll come back, but not to the same strength that it had before. I think there'll be a lot more online learning. Debt-free has many advantages, including peace of mind, zero risk of being foreclosed on, the flexibility to withstand vacancy, recession. Brent, being debt-free is, you basically make the assumption that you're not, like, to be debt-free, you basically have to be a bad investor. The only way you can swallow being debt-free is if you say, hey, I'm a terrible investor who will not take risk. And by definition, someone who doesn't take risk is a terrible investor, right? They don't invest in, and everything has risk, right? There's a risk-reward equation. So if you want to have no risk, that means you want to get a no return. There's no return that has no risk. Like, if you want to put your money in your bank account at the bank, that carries risk. And get out of your car and drive somewhere, it carries risk, right? It's just, you want to try to manage your risk, get as low as you possibly can by, you know, buying properties under market value, buying stocks under value, whatever, you know, buying businesses under value. So you're buying day one to protect against the risk, right? That's all you can do, is protect against risk as much as you possibly can, and then try to get a great return. So I try to get as much return as I can without taking a lot of risk. And that's just been my, you know, I'm not buying junk bonds. I'm not investing in just like willy-nilly real estate. I'm just buying stocks, you know, whatever. I'm being very targeted in what I'm buying. And so I think that that's, you know, that's important. But yeah, I think that like this no debt crap is basically just for people who are okay with, you know, a zero return. That's, you can't retire early. You literally can't retire early unless you believe that you can live on the passive income of your wealth. So if you believe you can't generate passive income, because if you didn't want any risk, then you would have no passive income, right? Because in order to generate passive income, you have to take some level of risk to invest in the stock market, to buy a business, to buy a house, to buy rental properties, whatever. Anything you want to invest in has a level of risk. Invest in the government, buy, you know, municipal bonds. They pay 6-8%, in some cases 9%, and they're like the risk that the city fails or goes bankrupt. City of London could go bankrupt. You can go buy municipal bonds that back it. I think the government's going to be probably pretty fine. It's a pretty low risk investment, but again, carries a level of risk with it. Everything carries risk with it. And you can insure against those risks, et cetera, and so forth, which again, cut into your return, but you got to make the play that works for you, I guess, at the end of the day. William, no problem. Thoughts, shares by holding the future and having a credit line. Yeah, I mean, you totally could, yeah, in the same way. Definitely. You could lever up in the same ways. Hi, Mike. Hi, Philippe. Ace says, what amortization term do you usually use for your properties? The longest I can, so 30 years typically, 25 to 30 years. Depends on the lender, depends what kind of rates I can get, but as long as I possibly can, because I don't want to pay down my mortgage. That's not the idea. You want to refinance the money out and buy more properties. Better to have 100 properties, or better to have 5 properties, 20% down, each cash flowing you positive, than 1 property owned outright. You'll always have a better return from 5 than you will from 1 if you're smart about what you're buying. I guess in a market crash, if you're dumb about what you bought, then you'd be punished at a 5-to-1 rate as well. And that's the idea with leverage, is that with debt, it punishes your mistakes. So the idea is just don't make bad investment decisions. Buy with 10%. If it property's worth $100, pay $80 for it. So if the market crashes 10%, you're still above water. Crashes 20%, you're still break even plus all the cash flow you had, right? Crashes 30%. You're down 10%, but you made all the cash flow the whole time. So you're still up. If you have multiple layers of ways you can win, then you still win no matter what. And that's the idea, is set so many things in your favor that you can't lose. It's sort of the idea. But yeah. I agree, businesses should be cleaning and sanitizing before COVID-19, protecting people from the flu as well. Totally agree. Mike, can you get LLCs financed in the States with Loan Depot? Or you can, okay. It is a little higher fee up front, but use them in Detroit later this year. Yeah, I mean, totally. There are companies that, sounds like Loan Depot is one of them, that will take advantage of that, yeah, and they will loan to the corps. So it doesn't necessarily have to affect you negatively. But again, there are certain lenders who do look for that T4, and so those lenders, I guess you'd be disqualified from. But there's always a lender who will take a risk on you. And again, if you're a higher risk to them, they're going to charge you more. That's it. I'm new here in Canada with my wife and 3 children. We're looking for a 2-bedroom apartment. My question is, where in the GTA is best for us, and how much will the cost of the rental be? Teddy, it depends on a lot of factors, what you're looking for, like a basement apartment versus whatever, like above ground, etc. There's so many different streets and areas, and there's opportunities all in between. The good thing is rent prices are coming down, and there's not a lot of tenant demand, and so you can take advantage of negotiating a little bit on the rental unit. You might be able to throw out, apply to 20 or 30 ads, go see 20 or 30 places, and negotiate in each one and offer them $100 less than what they're asking for their rent, and someone will probably take you, and you'll probably get a discount on your rent. So now's the time you can do that, which is awesome. I don't know market prices in Toronto for rent around the different areas, but the further away you go from the core, the cheaper it gets. That's pretty much a rule of thumb. So maybe find one that's on a good transit system to where you want to work, and go within, on a map, draw an area, say you're okay living here, and then go look at properties in that area. Hi Mike, I live in the GTA, which is expensive. I want to purchase my first student rental next year. Any tips on locations? How far away would you recommend purchasing my first property? It depends on so many factors, but yeah, I mean, it's up to you. How far away? The further you go, the better your cash flow is going to be too, because the price to rental income ratio, the cap rate, gets better the further out that you go. So yeah, I mean, the closer you are to the core, the more expensive it's going to be, the worse your cash flow will probably be on average, but the better long-term market fundamentals that you'll have. No problem, happy to help. Is there a certain age that you think a person's primary residence should be paid off, or should a person never pay off their primary residence? Thanks. I'll never pay off my primary residence ever. I always believe that's not true. If market conditions changed and interest rates went way, way up, I might be of a position that it would make sense to pay off your mortgage. But if you can borrow, my mortgage right now is at 1.34% 5-year variable. It makes no sense ever to pay that down. 1.34, that's free money. So if your mortgage is like 2% or less, it doesn't make sense to pay off your mortgage ever. I think I can go open a savings account in a government insured, I can go open at the bank that's insured by the government, right? What was the name of the company that insures deposits? It's like Canadian Deposit Insurance, CDIC or something, CDIC insured. So it's one of those things that if the government's backing, I think up to $100,000 deposit by CDI, Canadian Deposit Insurance. Oh, Shaylin says CDIC. So it is the CDIC. Basically, I think it's around $100,000 in every single account that you have. And so the beautiful thing about that is, like, I go open a savings account, a few months ago before COVID, and they had promotions like 2.5% interest, 3% interest at Scotiabank. I can go take the money from I'd rather take the money instead of paying off my mortgage and put it in a savings account at the bank. So the bank has to fail, and the government that's insured, the government agency, CDIC, has to fail before I lose any money. So the risk is like super low, right? I'd say it's safer to put the money there than it is to pay it back to the bank on my mortgage. It's literally safer. And I get 2.3% return, and I'm cost of debt at 1.34. So I can't think of a scenario right now where it makes sense to pay off a mortgage, especially if it's tax deductible too. If it's on a rental property, it's tax deductible. If you're in the top marginal tax bracket, your interest cost is really half, right? So if you have a 3% mortgage, half of that interest is tax deductible. So you're really paying 1.5% on a 3% mortgage net, right? So you kind of want the write-off, to be honest. I can't think of a situation where you want to pay down a rental property. It's just, if I'm paying down a rental property, I'd rather just sell the property. If you give me a property in cash, I'll just sell it. You give me a property and you're like, hey, you have to, you can't ever lever this property up. I'd be like, getting rid of it. Like, I have no interest in holding real estate without leverage. I would just take the money and invest in like a stock or a business, or I'll get a way better return. Real estate in cash is a terrible return. It's only great because you can borrow so much. Okay. Hey Liam, how you doing? Thank you so much for the tips. Hey, no problem. Happy to help. How much do you think rents will drop? In the start of the video, I kind of covered it. I think probably like a 10%. We'll find a place where, like, as prices drop, landlords will find a vacancy rate that makes sense. Vacancy rates will play in too, and there'll eventually be a floor, right? A resistance where, to be honest, I think it's short-lived. I think as soon as immigration comes back online, schools come back online, travel comes back online, we start with people moving and renting places, and then all of a sudden this open inventory is just sitting there. It gets rented up real quick, and then there's a huge shortage. And so when the shortage exists, again, then we'll see rents jump back up. Okay, thank you everyone so much. I don't know what Rajesh's comment was deleted, so I can't see it. But thank you so much for joining in, everyone. And Ron says, what systems will be used to conduct online learnings? Which companies to invest in for these systems? I don't know. You'd have to do a Google search on that. But I'm sure there's going to be opportunity there as online systems become the new way of delivering content for learning. And I think that is the way that things are going, right? YouTube might be one of those platforms. People are going to be on YouTube more than ever to learn, right? Think of like those Zoom calls and things like that. Companies like Zoom are doing really well right now, and et cetera and so forth. Hit the like button, everyone. Thank you. Yeah, no one hit the like button today. If you're still watching at 72 minutes on the replay, thank you for watching the replay. And let me know in the comments of the replay that you watched it. It means a lot to let me know that I gave you an hour and 15 minutes of my time tonight. And the least you can do is say thank you and jump in the comments and just give me a comment. Even if it's like, hey, Mike, disagree with you entirely. Cool. At least you let me know you engaged in the content, that I didn't just waste my time. So thank you so much, everyone, for watching. And as always, the secret to unlocking a wealthier you has 3 levers. You gotta spend less, control your spending. You gotta earn more so you can save more and invest the difference. So spend less, earn more, and maximize returns on the difference. Thank you, everyone, so much for watching, and I'll see you next week. Bye, everyone. And let me know in the comments if you think I should start dropping regular videos again. I'm thinking about getting my camera back out and doing like 10-minute unedited videos where I'll just go like 10 minutes on a topic, hardcore, and just post the video with a good thumbnail. And I won't go hard on the editing, and it'll be what it'll be. Oh, sorry, my battery's dying. Good night, everyone. See y'all next week.